You know, if you've been keeping an eye on the markets lately, you've probably felt it. This kind of nervous energy, a real sense of uncertainty. Well, it's a feeling that has all the professionals talking, and today we're going to break down exactly what's causing this wave of trepidation.
And man, this quote from Goldman Sachs just nails the mood perfectly. They're seeing lots of degrossing, a term we're about to get into, and it's triggering collective hand-wringing. Honestly, understanding this one concept is the key to unlocking the whole puzzle of the market's anxiety right now.
So that's the big question, right? After a pretty solid run, why the sudden fear? What on earth has changed to make so many investors suddenly hit the brakes all at once? Well, the answer starts with that word you just heard, degrossing.
Okay, so what is degrossing? Put simply, it's when the big money investors decide it's time to lower their overall risk. And they don't just sell their losers, they sell their winners too. Everything. It's a fast, broad sell-off designed to shrink their total footprint in the market. You can think of it as cashing out your chips and just heading for the sidelines for a little while.
Okay, so what's actually driving all this degrossing? Well, the first piece of the puzzle starts right at the top, with the biggest players in the global economy, the central banks. And right now, what we're seeing is a tale of two very, very different policies.
On one side of the ring, you've got the U.S. Federal Reserve. They're kind of signaling that their big campaign of tightening up the money supply might be wrapping up. But then you look across the Atlantic, and the European Central Bank, they're sticking to a much tougher, more restrictive path. And this creates this huge tension, a divergence that's pulling the entire global financial system in two different directions.
And a key tool they're using here is something called quantitative tightening, or QT for short. This is basically when a central bank starts shrinking its own massive balance sheet, which has the effect of sucking cash right out of the financial system. It's literally the opposite of printing money, and it makes financial conditions tighter for everyone.
And you can really see this growing divide when you look at the chart. The Eurozone's central bank balance sheet, as a share of its economy, has already plunged below 15%. Now, with the US Fed getting ready to stop its own QT, this gap with Europe is just going to get wider. That means liquidity, the cash sloshing around, is getting a whole lot tighter over there.
All right, so this big macro-level tug-of-war, it has a direct, and I mean direct effect on investor psychology. After a year of really strong gains, a lot of people are looking at this moment as the perfect time for what we can call the great unwind.
Now, this isn't necessarily about outright panic. For a lot of professional investors, this is just about being prudent. I mean, they've had a great year. So rather than try to defend their positions in this super uncertain environment, they're choosing to lock in those profits, to, take their chips off the table and secure the win.
And where are they selling? Oh, you guessed it, in the most popular, most crowded trades of the entire year. We're seeing some really sharp pullbacks in huge themes like AI infrastructure, quantum computing, and, no surprise here, those high-flying, non-profitable tech stocks that have had a ridiculous run-up. Because when everyone rushes for the same exit at once, these are the areas that get hit the hardest. And what's really interesting here is that the professional money, the big institutions, they've actually been pretty cautious all year long. They've kept their overall market exposure, what they call their net leverage, relatively low. It's a signal that they've been wary of these high valuations for a while.
And this is where it gets really fascinating. While the big institutions have been tapping the brakes, individual retail investors have been doing the exact opposite. They've stayed incredibly risk-seeking, jumping into the market with everything they've got. And this creates a wild tug-of-war.
And I'm not talking about a small trend here. Retail trading has been absolutely explosive. In fact, it recently accounted for the highest percentage of total S&P 500 trading volume in a 5-year data set. Let that sink in. That is a truly staggering statistic.
So you've got this whole setup, right? Central banks pulling apart, pros and retail on opposite sides of the trade. The whole thing was like a tinderbox. It just needed a spark. And that spark came from the super volatile world of commodities.
So what was the catalyst? What was the event that finally flipped the switch and turned that cautious feeling into active, widespread selling? Well, it was a 1-2 punch that started with a certain precious metal. Okay, so here's how the chain reaction went down. First, gold prices went on this insane meteoric rise, only to reverse just as sharply. According to Goldman Sachs, that reversal is what really kicked off the degrossing. Then, right as that was happening, boom, new sanctions on Russia caused oil prices to spike over 4%. This combo of shocks in two critical commodities was all it took to send a jolt of uncertainty through the entire market and just pour gasoline on the sell-off.
So after all that, the diverging policies, the big investor unwind, the commodity shocks, where does that leave us? Well, it leaves us with a market that is deeply, deeply divided about what comes next.
So let's just quickly recap the key takeaways here. First, when the world's biggest central banks start pulling in opposite directions, it creates serious tension and uncertainty. Second, the most popular and crowded trades are always the most vulnerable when sentiment suddenly shifts. And third, never, ever underestimate the power of a sudden shock in commodities to light a fire under the entire market.
And that brings us to the final and, I think, most provocative question. You have the so-called smart money, the big institutions de-risking and selling, and at the exact same time you have an army of retail investors buying with unprecedented enthusiasm. The question that's going to define this next chapter for the markets is a simple one. Who is right?